Lately, people have been asking me, what is the biggest mistake that you've seen, or what is the mistake that people make most often? And I think it is that once the market is moving in one direction, that it will always continue to do so.
I don't know if you've noticed, but so far in 2024, the stock market has been booming. It's up around 14% already, and we're not even halfway through the year. The economy is still growing, 2.88% above inflation recorded in Q1, which was a little slower than previously measured, but still impressive. Unemployment ticked up slightly, but remained at record lows, and inflation, well, it's got some work to do, but it has been approaching the ideal 2% target. But the release of these broad macroeconomic indicators, for the most part, just impact market sentiment. How do investors feel about owning pieces of companies? What really matters is company profits, and that's where things get interesting. This chart shows the return of the S&P 500 index in 2024 so far, as I said, up 14%, but compare that to the growth of company profits. The earnings of American companies listed on the stock market actually fell in the first quarter, and in total is expected to grow less than 2% by the middle of the year. So wait a minute, if company profits haven't been growing this year so far, how come the stock market is having one of its best years ever? Well, check this out. This is the expected earnings growth of the S&P 500 for the full year. It's about 12%, or in other words, the stock market is pricing in the next 6 months of earnings growth. Now, of course, this is actually pretty normal. It's just how markets work. People buy stocks based on what they think earnings will do in the future, not what they've already done. But it puts us in a very interesting position, especially when we look at something called the fear gauge, the Chicago Board of Exchange Volatility Index, which you might have heard referred to as the VIX. And basically, it uses a bunch of fancy maths to measure how much traders and investors expect stocks to move up and down in the near future. At the moment, it's at a 5-year low, so while the direction of stock movements have been pretty much just up this year, generally, it's been a calm, steady rise. Another chart the Wall Street Journal shared makes this point a bit clearer. This is a measure of the one-day movements up or down of the S&P 500 stocks. Every month this year, the daily movements of stocks have been lower than the 10-year average. But so what? The stock market isn't moving around dramatically all over the place. Wouldn't that be considered a good thing? Remember March 2020 when stocks fell 30% in 5 weeks? Well, the volatility index reached 53. Today, we're just at 12, and it's much more comfortable to invest in a market like this than a 2020 market. But that is exactly the point. Calm markets feel good to invest in, but they also generally don't last.
You know, everybody knows that the market and the economy and politics move cyclically. And, nothing moves in a straight line where human behavior is involved. And if you were to count on it doing so, you would get into big trouble.
Low volatility markets breed complacency, and what that means in financial markets is investors start taking more and more risk that eventually doesn't pay off. This is just human behavior 101, and it actually also applies to companies.
People go to excess. And for example, if the economy is growing well for a few years, business heads say, oh, well, we have to build a new factory to get our increased share of the growth in our industry. And so they do, but so does everybody else. Now there are too many factories, and now the factory utilization falls and the companies go into decline. So then they pull back. And they stop building factories.
The first half of 2020 has been relatively calm, but you should be aware of the big factors and events that are going to influence stocks in the second half of the year. 3 of these factors, to be specific. How just 7 strong performing businesses are hiding the fact that the other 99% of companies have been in an earnings recession, the November US election, not from a political perspective, but how the results tell us how the market might move next year, and even more fascinating, how the stock market may actually predict the election result. as well as what's been happening at the Federal Reserve, or to be precise, what changes they just announced. But just before I get to that, I want to pause the video quickly and talk about something that's actually really important to me, and something that I know affects a lot of people, and that's mental health. And because of my experience in dealing with mental health issues and the way I was able to overcome some of these with therapy, I've decided to partner with BetterHelp as the sponsor of this video. Almost all of my audience are men, and we in particular have a tough time opening up to the people around us. I know this from personal experience. I've dealt with social anxiety, and at times it's made it difficult to maintain healthy relationships. I like solving problems on my own, but sometimes you just need to reach out for help, and that's where therapy can help you. It's a safe space to talk through your mindset and thoughts, and I think the most valuable thing for me was hearing new perspectives on what I was going through. If you're struggling with something in your life, maybe it's anxiety or depression, know that seeking help is a sign of strength, not weakness, and that's where BetterHelp comes in. They offer online therapy with a wide network of licensed therapists who specialize in different areas, so you can find the right fit for your needs. With BetterHelp, you can communicate through video chats, phone calls, or even messaging. Plus, you can easily switch at no additional cost. BetterHelp is making therapy more accessible and convenient than ever before. If you're interested in giving online therapy a go to betterhelp.com/Hamish Hodder or select Hamish Hodder at sign up for a special discount off your first month. Investing in your mental health is one of the best things you can do for yourself, so don't be afraid to reach out for support. One of the big themes this year has, of course, been artificial intelligence. And I've already spoken about Nvidia and some of the other companies that have been benefiting on a company level from the rise of AI, so I'm not going to talk about that in this video. Instead, I want to talk about something that, at least to me, is much more interesting and is certainly more relevant, especially if you're an index fund investor. The S&P 500 comprises of 503 different stocks. Some companies like Google's owner Alphabet have two classes of shares, so that's why there's 503 and not 500. Anyway, that's not the point. When you're invested in the S&P 500, you would expect, right, that 0.2% is 500 companies, 0.2% of your money is going into each company, right? Wrong. The S&P 500 is weighted by the current value of each company. Your money mostly goes into the big ones and a tiny amount goes into the small ones. And I know most people probably already know this, but in 2024 in particular, this makes a big difference. Currently, just 10 stocks represent almost 37% of the value of the index. And it basically means that the performance of the S&P 500 just warps our perception of how American companies are actually performing. The S&P 500 is up 14% this year, but the equal weighted index is up just 4%, and it's been flat since March. The big companies that have been flexing their AI muscles recently have been driving the market. Microsoft up 21%, Nvidia up 172%, Apple up 17%, and pretty simply, the stock prices are rising a lot because their profits are rising a lot. According to European Capital Partners, the Magnificent Seven companies have increased their earnings by 58% since November 2022, while the rest of the S&P 500 have seen profits fall 8.4% over those 18 months.
There are people who believe that that the AI stocks, for example, are in a bubble, and most bubbles do surround something that's new, and this one does, and something that everybody's very impressed by. I don't know enough about AI to know if this is excessive or justified.
No one knows what will happen with AI and the Magnificent Seven companies, and frankly, it doesn't matter if you're a long-term investor. But for the rest of the year, those 7 companies in the Magnificent Seven are going to hold the key to the results we see for the S&P 500. And so does the US election, which will be held in November. Not only does the stock market usually move a certain way leading into an election and after an election, but the stock market may actually also be somewhat of a reasonable predictor of who's going to win. Daily FX did an analysis of the 22 US elections held since 1932 and found that in the election year, the stock market was positive 18 times and negative 4 times. So far, that trend is true this year. The market would need to fall more than 12% from here for the year to finish in the red. But that's not surprising at all, because in any given year, the stock market is usually up anyway. Most years are positive years. What's interesting is the correlation between the 1-year performance of the stock market and the election result. If the market was up going into the election, the incumbent won 61% of the time, which would be Biden in this case. If the market was negative, 75% of the time, the incumbent lost. And if we zoom in even further and look at stock returns just 3 months out from an election, so in this case, August to November this year, when the market was positive, 85% of the time the incumbent won, and when negative, 89% of the time the incumbent lost. Of course, I don't think anyone should take this particularly seriously, because there is one glaring problem with this, and it's that there's such a small sample size of just 22 US elections that we can work with, but I just thought it was interesting. There's also a correlation between election results and the stock market performance after the election. US Bank looked at a variety of scenarios with different parties controlling the White House and Congress after the vote. They found 3 statistically significant results, all where there is a divided control over the executive and legislative branches. A Democratic White House with a split Congress had the best returns after the election. Again, does any of this matter if you're a long-term investor? Absolutely not. That brings us to the Fed. At the FOMC meeting last week, they once again decided to hold interest rates at 5.25 to 5.5%. The same decision they've made at every meeting this year so far. But what made this particular meeting unique is that we also got their projections, or their updated projections, for where they see interest rates in the economy by the end of the year, which showed committee members now expect either 0, 1, or 2 rate cuts before the end of the year, once again adjusting their expectations down. Back in December, most members were planning for 2, 3, or 4 cuts, with one crazy member even thinking 6 rate cuts.
In December, what I thought might be wrong, well, in December, there was a high degree of consensus that the Fed would cut rates 6 times this year.
Yeah.
And I said I thought that was excessively optimistic. I described it as Goldilocks thinking.
The lesson being, even the Fed has no idea what will happen over the next year. No one has a crystal ball, and whatever the current projections are could be very different from what ends up happening, even over just the next 6 months.
But when we're extremely high and people get excited and say, hey, this is going to go on forever, usually it will collapse eventually of its own weight. So when the market is crazy high or crazy low, I think we can make a profitable forecast. The only thing is, Nikolai, that we don't get too many opportunities.
Even as someone who watches the market cycles closely, Marx is fully aware that most of the time, you just can't make macroeconomic predictions. Most of the time, the probability that the market will go up or down in the next 12 months is just too close to 50-50.
Let's say that you and I can agree that the S&P is 20% overvalued today, which I think is probably a good estimate. The PE ratio is 21. The post-war norm is 16. So 25% overvalued. And let's say we agree on that, and let's say we're right. The next question is, what is the probability that it's going to decline in the next year? It's modest. It's probably a little better than 50-50, but it's not 100 or 90.
Is the market going to play its Uno reverse card and go down for the rest of the year? Maybe, maybe not. But ultimately, it doesn't matter. Just keep investing consistently and have a long-term perspective, and nothing that happens in the short term is relevant.
If you want to make money, you have to take risk, but you should not expect to make money just for taking risk. You have to do it skillfully. So there is a process that I call the intelligent bearing of risk for profit. And we try to engage in that. It has to be risk you're aware of, risk you can analyze, risk you can diversify, and risk you're highly paid to take.
Subscribe for free if you enjoyed the video, and check out some of these videos next.